Hey there, neighbors. It's Nicole Fetter, your local Arizona realtor. Over the past few months, we have watched interest rates on home loans just continue to go up. It's got a lot of people freaking out and wondering, will it ever stop? Yes, eventually it's going to stop. If we look back historically, we've been talking historic interest rates quite a bit lately. If we look back, the mid-sixes is not very high compared to the 80s and 90s. In the 80s, interest rates on home loans were in the mid-teens. See? Sixes, not so bad. Actually, over the past few weeks, we've seen a dip in interest rates. We will likely to see more increases coming soon, but for now, we have seen some dips. There is a lot that goes in to what happens with interest rates, and quite honestly, most people don't understand what affects our interest rates. So today, we are going to talk about the different factors that go into interest rates. Fed, bond, inflation, the economy, your own personal financial situation, including your credit score, amount of money you're looking to borrow, your debt to income ratio. Again, just a lot of information goes into it, and not everybody understands what affects interest rates. So today, we are going to go over some of those factors. The Fed rate. There's no direct correlation between the Fed rate and mortgage interest rates. However, mortgage interest rates do seem to magically follow the Fed rate. Meaning, if the Fed were to lower their interest rates, usually mortgage interest rates follow and go down. Fed increases, usually mortgage interest rates follow and go up. However, if central bank were to lower the Fed rate to zero, that does not mean mortgage interest rates are going to be at zero. The Fed rate is simply the rate at which banks loan money to each other overnight. It is supposed to be there to help maintain inflation, to keep a stable increase in inflation. I guess that leads us to inflation, the increase in prices of goods and services. Throughout the last year, we have seen inflation go through the roof. I'm not going to try to give you a number because it seems like everybody has got a different percentage of inflation they're trying to say. What I do know is it feels like gas prices has almost doubled. Everything I buy at the grocery store, much higher than it was just a year ago. What huge inflation means for all of us is less buying power. If you were a bank, how would you get people to borrow money when they have less buying power? Lower the interest rates. So obviously, same goes for the opposite. Higher interest rates when they have more buying power. Economy. We've all got to see this one in action with COVID. Good economic news means higher interest rates. Bad economic news, lower interest rates. During COVID, mortgage interest rates when it first begun were in the mid-fives. COVID hits, interest rates are in the twos. Trying to push people to go out there and purchase and spend money, keep the economy stable and going. So good, high, bad, low. We've talked about several things you can't control as far as what affects mortgage interest rates. Hopefully that gives you a clear picture of why it is nearly impossible to ever guess or judge what is going to happen on any given day with interest rates. Having said that, there is several things you can do to ensure that you get the best interest rate possible when it comes to your personal financial situation. Let's jump in and look at some of the things that affect interest rates that you can control. Credit score. Credit score is going to be one of the three biggest factors that a lender looks at when deciding whether to lend you money and what interest rate they are going to give you. Your credit score, the higher the better, lower the worst. It shows your reliability in paying people back, paying them back in a timely fashion, and whether you use too much credit or not. It would also give your lender information on whether you've ever been delinquent or late on mortgages and rentals. Basically, higher better, lower worse. Again, it shows your reliability of paying the lender back and paying them back in a timely fashion. Income and down payment. The more money you make and the higher the down payment you put down, the less risk you are. It's also the less debt to income you will have. The debt to income is a percentage, a monthly percentage of your debt compared to how much money you make as income. This is, again, one of the big three factors the bank looks at. The lower your debt to income, the lower your interest rate. The less risk you are to not pay the bank back and to not pay them back in a timely fashion. So low debt to income ratio, high income, high down payment, all great things to getting the lowest interest rate possible. The short of it, a lot goes into where mortgage interest rates lie on any given day. It is impossible to predict. We do not know what's going to happen today or tomorrow. We do usually have a good idea of whether mortgage interest rates are going to increase or decrease, but other than that, we can't predict where they will fall. As far as you buying a home and wanting to wait for interest rates to lower, that may happen, but when? And then where will we be as far as values of home? The best time to buy a home for you is when you are financially ready. Jump in, buy that home, start building that equity, and if interest rates do come down to 2, you can always refinance into that 2% interest loan. The most common loan is a 30-year fixed, meaning for the whole term of your loan, you're at the same locked interest rate. There is also a lot of different programs that will help us buy down your interest rate if you are interested in that. If you have any questions, just call, text, email, or direct message me. I'm always here to help with your home buying and selling needs. Thank you for taking the time to watch this video. Please like and share it with your friends and family. Help continue to educate them on the home buying and selling process. And remember,
go better with better. Your love.